Most people are misreading XRP right now. The recent market chaos has convinced many investors that crypto is breaking down, but beneath the volatility, the market structure may be changing in ways institutions have been waiting for. What looks like panic could actually be the final stage of a much larger transition. In the next few minutes, we'll break down the macroeconomic forces driving this sell-off, why institutional investors are paying close attention despite the fear, and what recent developments could mean for XRP and the broader crypto market over the long term. See, over the past few weeks, we've seen hedge funds unwind positions, risk assets come under pressure, bond yields climb, and geopolitical tensions return to the forefront. At first glance, these events appear unrelated, but when you connect them, a very different picture begins to emerge. Rather than signaling the end of crypto's next cycle, these developments may represent a market-wide cleanup, one that removes excess leverage, reshapes investor positioning, and lays the groundwork for the next phase of institutional participation. And that's where the story becomes much more interesting. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the markets. See, one of the biggest misconceptions in crypto is that digital assets trade independently from the rest of the financial system. In reality, today's markets are deeply interconnected. Institutional investors don't manage crypto in isolation. They manage diversified portfolios. If volatility spikes in equities, if bond yields rise, if currency markets become unstable, portfolio managers often reduce exposure across multiple asset classes simultaneously. Crypto becomes part of the broader risk management decision. This explains why Bitcoin, Ethereum, and XRP can sometimes fall, even when there's no crypto-specific negative news. Let that sink in. The selling pressure isn't always about blockchain technology, ladies and gentlemen. Sometimes it's simply about managing overall portfolio risk. Understanding this distinction helps investors separate temporary market reaction from long-term structural developments. And that's where the story becomes much more interesting, ladies and gentlemen. See, recent reports of struggling crypto firms, forced liquidations, and stress trading positions have understandably worried investors. But experienced market participants often view these moments differently. Periods of excess leverage rarely end quietly. When borrowing becomes too aggressive, prices stop reflecting genuine demand. Instead, markets become dependent on borrowed money continuing to flow. Eventually, that cycle breaks. Positions are forced to close. Speculators exit. Weak balance sheets fail. And although the process is painful, it removes instability from the system. Several institutional voices have suggested that much of crypto's speculative leverage has already been significantly reduced compared with previous cycles. Whether this process is completely finished remains uncertain, but many investors view deleveraging as a necessary step before healthier market participation can return. Because sustainable bull markets aren't built on excessive debt. They're built on confidence, ladies and gentlemen. This idea isn't unique to crypto. History has shown it before. In the 1907, the United States experienced one of its worst financial panics. Banks failed, trust companies collapsed, and liquidity disappeared overnight. Investors rushed to withdraw their money. Confidence evaporated. The financial system looked dangerously close to breaking. It took coordinated intervention led by financier JP Morgan and other bank leaders to stabilize the system and restore confidence. But here's why the panic of 1907 still matters today, ladies and gentlemen. That crisis exposed structural weakness in America's financial system. Rather than ending finance, it accelerated reform. Just a few years later, the Federal Reserve was created to provide greater financial stability and reduce the likelihood of a similar crisis. The panic wasn't the end of the system. Nah, it became the catalyst for building a stronger one. Markets often evolve this way. Periods of stress expose weakness that eventually force improvements. Now, this is what most people miss. Crypto may be experiencing a similar process, not identical, but comparable in principle. While retail investors often focus on daily price movements always, large financial institutions usually focus on infrastructure. Their questions are very different. Can digital assets be safely held? Are regulators clear and regulations clear? Can products be offered legally? Can compliance departments approve investments? Can pension funds participate safely? These questions matter far more than whether XRP moves 5 or 10% in a single week. Institutional capital generally arrives only after legal and operational risks become manageable. That's why discussions surrounding regulatory clarity have become so important. Some of the world's largest financial firms have repeatedly indicated that regulation, not technology, remains one of the key hurdles preventing broader institutional participation. The blockchain already exists, ladies and gentlemen. The payment infrastructure already works. The missing ingredient is legal certainty. One of the most closely watched developments in the United States is the ongoing efforts to establish clear rules for digital assets. Supporters believe comprehensive legislation could define how different cryptocurrencies should be regulated and which agencies have oversight. That clarity matters because uncertainty creates hesitation. Investment firms managing billions or even trillions cannot simply guess what future regulation will look like. Their legal teams require certainty today. Their compliance departments require certainty today. Their clients expect certainty. Without that framework, many institutions remain cautious, regardless of how promising the underlying technology appears. It's important to separate two very different ideas. New regulation will not suddenly make blockchain useful overnight. Many blockchain networks, including the XRP ledger ecosystem, already support real-world transactions today. Instead, clearer regulation would make it much easier for traditional finance and institutions to build investment products and financial services around existing blockchain technology. Prices reacting, systems evolve. That's an important distinction. See, for XRP holders, recent volatility has been expressly frustrating. Prices have struggled to establish sustained momentum despite continued discussions surrounding adoption and regulation. Many traders continue watching important support and resistance levels. Support represents areas where buyers have historically entered the market. Resistance reflects zones where selling pressure tends to increase. Some analysts have identified approximately $1.05 as a key support area, while the $1.20 region continues attracting attention as resistance. These levels should never be viewed as guarantees. Markets frequently move above and below technical zones. Instead, they provide useful insights into market psychology and trader positioning. More importantly, technical charts tell only part of the story. Macroeconomic conditions continue influencing crypto prices every single day, which brings us to another global factor that many retail investors overlook. Another source of pressure has emerged from international currency markets. For years, investors benefited from what's known as the carry trade. In simple terms, money was borrowed in countries with extremely low interest rates and invested into assets offering higher returns elsewhere. As long as exchange rates remained relatively stable, the strategy worked well. But when interest rates expectations change or currencies begin moving sharply, those positions can unwind surprisingly fast. When investors rush to reduce leverage simultaneously, markets around the world often experience sudden volatility. Crypto isn't necessarily causing that volatility. It's simply caught in the broader wave of global deleveraging. That's why understanding macroeconomics has become increasingly important to anyone investing in digital assets. The blockchain may operate 24 hours a day, but global capital still follows economic incentives. Despite rising bond yields, despite geopolitical uncertainty, despite volatile price action, institutional conversations around digital assets haven't disappeared. If anything, they have become more focused. The discussion is gradually shifting away from whether digital assets belong in financial systems towards how can they be integrated responsibly. That's a subtle shift, but it's an incredibly important one. Because when markets stop debating survival and begin debating implementation, the entire long-term conversation changes. Short-term noise, long-term structure. Today's price movements capture the headlines, but beneath the surface, the financial system continues evolving. And as you soon see, history has shown that some of the biggest transformations begin long before the majority of investors recognize what's happening. If you haven't spent enough time in financial markets, you'll notice a pattern that repeats itself over and over again. By the time the average investor feels comfortable buying, the biggest opportunity is already passed. Why? Because markets are forward-looking. They don't wait for perfect news. They don't wait for certainty. Instead, they begin pricing in what investors believe could happen months before the headlines finally change. That's why institutional investors spend less time reacting to today's market and moves and far more time studying where the financial system may be heading over the next 5 to 10 years. Right now, crypto finds itself at one of those crossroads, and it's fascinating as far as I'm concerned, ladies and gentlemen. On one side, there is undeniable uncertainty, higher interest rates, persistent inflation concerns, geopolitical tensions, regulatory questions that still haven't been fully resolved. But on the other side, we're seeing increasingly discussions around tokenization, digital asset infrastructure, blockchain-based settlement, institutional custody, and regulated investment products. Those two stories may seem contradictory, but throughout history, periods of uncertainty often have been the very moments when the foundation for the next financial era were quietly built. It's easy to become obsessed with price, ladies and gentlemen. Everyone looks at this all the time. That's why people invest, you might be asking yourself, right? But after all, that's what dominates social media, unfortunately. Every small move higher becomes proof the bull market has returned. Every correction becomes evidence that everything is collapsing. But experienced investors understand that price is only one piece of a much larger puzzle. See, markets move for countless reasons. Sometimes they're driven by company earnings, sometimes by monetary policy, sometimes by geopolitical, and sometimes they're simply reacting to shifts in liquidity. Crypto is no different. A sharp move in XRP doesn't automatically mean something fundamental has changed about the technology. Likewise, a period of sideways trading doesn't necessarily mean progress has stopped. Behind every chart lies a much bigger story, and that story is becoming increasingly institutional. To understand why this matters, let's go back to one of the most famous moments in financial history, okay? The dot-com bubble. During the late 1990s, investors poured enormous amounts of money into internet companies. Businesses with little revenue achieved extraordinary valuations simply because they had an internet-related business model. Then reality arrived. See, between 2000 and 2002, technology stocks suffered one of the largest crashes in modern history. Thousands of companies disappeared. Investors lost billions. Many concluded that the internet itself had failed. But here's what actually happened. The speculation collapsed. The technology didn't. While investors focused on falling stock prices, engineers continued building. Internet infrastructure improved. Broadband expanded. Cloud computing began taking shape. Businesses quietly integrated digital technology into everyday operation. See, years later, companies built upon that stronger infrastructure transformed the global economy. It did. Crypto could be experiencing a similar distinction, not necessarily the same outcome, not the same timeline, but the same principle. Speculative excess can disappear while genuine innovation continues advancing underneath. That's a distinction investors should never ignore. This brings us back to XRP. One of the biggest misconceptions surrounding XRP is that regulation somehow creates its usefulness. It doesn't. The XRP ledger already exists. Cross-border payment technology already exists. Settlement capacities already exist. Utility doesn't suddenly appear because legislation changes. What regulation does is provide something very different: confidence, legal clarity, operational certainty for banks, asset managers, insurance firms, and pension funds. Those factors matter enormously. See, these institutions cannot simply invest based on optimism. They operate with strict legal and compliance frameworks. Until those frameworks become clearer, many large organizations remain cautious regardless of technology itself. That's why developments receive so much attention. They are less about changing the technology, ladies and gentlemen, and more about changing who feels comfortable participating. See, prices reacting, systems evolving. I want you to imagine the construction of the railroad networks during the Industrial Revolution. In the early days, railway lines were fragmented. Different companies used different standards. Many investors questioned whether such enormous infrastructure spending would ever produce meaningful returns. There were delays, bankruptcies, speculation, and financial losses. Yet over time, as networks expanded and standards became more consistent, businesses gained confidence, trade accelerated. Entire industries emerged around that infrastructure. See, today's digital assets ecosystem shares some similarities. The blockchain resembles the railway tracks. Regulatory clarity resembles the standardized rules that allow everyone to use those tracks efficiently. Without common standards, participation remains fragmented. With greater certainty, participation becomes much easier. Again, this is an analogy, not a prediction, ladies and gentlemen. But history repeatedly reminds us that infrastructure often matters far more than early speculation. Now, it's important to keep expectations grounded. None of this guarantees higher prices. Far from it. Several risks continue hanging over the financial markets. Interest rates remain significantly higher than they were just a few years ago. Inflation has eased in many economies, but central banks remain cautious. Government borrowing continues increasing. Bond markets remain sensitive to inflation reports and monetary policy decisions. Geopolitical tensions can escalate unexpectedly. Energy markets remain vulnerable to disruptions. And if global economic growth slows more sharply than expected, investors could continue reducing exposure to risk assets, including cryptocurrencies. There are also crypto-specific uncertainties, ladies and gentlemen. Regulatory proposals may evolve. Legislation could face delays. Court decisions could influence market sentiment. Institutional adoption may take longer than optimistic investors anticipate. Markets rarely move in straight lines. Understanding both the opportunities and the risks create a much more balanced perspective, ladies and gentlemen. One lesson that's extremely important in financial history, it teaches repeatedly, is that patience and patient capital often outperforms emotional capital always, ladies and gentlemen. See, investors who react to every headline frequently find themselves buying high and selling low. Those who focus on long-term structural changes often think very differently. They understand that volatility is part of investing. They don't expect certainty. Instead, they concentrate on risk management, diversification, time. No one knows exactly where XRP, Bitcoin, or the broader crypto market will trade next month. Nobody consistently predicts every top. Nobody consistently predicts every bottom. But investors can evaluate whether the underlying system appears to be becoming stronger or weaker over time. That's a very different question, and arguably a much more important one. Think of a building, long-term wealth, like planting an orchid, okay? When you plant a fruit tree, nothing remarkable happens overnight. Weeks pass, months pass, sometimes even years pass. Most of the important work is happening beneath the surface. Roots grow deeper. The foundation strengthens. From the outside, it may appear that very little is happening. And eventually, growth becomes visible. Financial systems often evolve the same way, ladies and gentlemen. Infrastructure develops quietly. That's why I always say pay attention to what's quiet. Regulations mature gradually. Institutions adapt behind closed doors. By the time the wider public notices the transformation, much of the detailed and difficult work has already been completed. That's why experienced investors pay close attention to structural developments rather than focusing exclusively on daily price movements. Because lasting change usually begins long before it becomes very obvious, ladies and gentlemen. So what should investors be paying attention to? Good question, right? Monitor over the coming months, first, macroeconomic conditions, bond yields, inflation, central bank policy, employment data. These factors determine how much liquidity flows through global financial markets. Second, regulatory developments. Progress towards clear digital asset legislation could significantly influence institutional participation over the long term. Third, institutional behavior. Rather than focusing only on headlines, watch what major financial firms are actually doing. Are they expanding digital asset services, building blockchain infrastructure, launching regulated products, increasing investment in tokenization? Actions often tell a much more powerful story than press releases. And finally, keep technical analysis in perspective. Support and resistance levels remain useful, but they should always be viewed alongside the bigger macro picture, because markets are ultimately driven by a much more than a lines on charts, ladies and gentlemen. You have to understand this. It's much deeper than that. Perhaps the most important takeaway from today's discussion is this. Markets often appear their weakest just before confidence slowly begins returning. That doesn't mean prices have definitely reached the bottom. Nobody can know that with certainty. Market volatility could still lie ahead. Economic data may disappoint. Geopolitical tensions could intensify. Legislation may take longer than investors hope. All those outcomes remain possible. But beneath that uncertainty, something much larger could be unfolding. The conversation around digital assets is gradually shifting. Less debate about whether technology belongs, more discussion about how it should be integrated responsibly into the financial system. That's a meaningful transition, ladies and gentlemen. Over that, one extends well beyond today's price action. Short-term noise, long-term structure. Prices are reacting, the system's evolving. Pay attention to what's quiet, ladies and gentlemen. See, whether you invest in XRP, Bitcoin, Ethereum, or you're simply trying to understand the future of global finance, one principle remains remarkably consistent. Separate emotion from analysis, separate headlines from long-term trends, and separate speculation from general structural progress. Recent market turbulence has undoubtedly tested investor confidence, but throughout history, periods of disruption have often focused and forced financial systems to become stronger, more efficient, and more resilient. No one knows exactly when the next major move will begin. No one can predict every twist in the market, but investors who understand the bigger picture are often better prepared when the next chapter finally arrives. If you've enjoyed this deep dive into the macro forces shaping crypto, be sure to subscribe and turn on notifications so you never miss our latest analysis. And let us know your thoughts in the comments. Do you think we're witnessing another temporary correction or the early stages of crypto's next structural evolution? As always, thank you for watching, and I'll see you in the next video. Hope everyone's having a blessed Sunday, everybody. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. Like I said in yesterday's video, look, everything's driven right now by expectations. One of the biggest tricks I learned on the floor of the New York Mercantile Exchange from the people that took me under their wing to teach me everything. You don't trade expectations. You learn from expectations. If you're trading expectations, you're going to get crushed and cut up like sushi. You don't do that. Everyone's expecting certain events to happen. Banks have one set of expectations. Retail has another set of expectations. The local has another set of expectations. No one is correct with these. All have a different reason of why they're doing it. The banks are going to make their moves based on what the economics tell them. The economics are different right now because the telegraphing from the Fed has changed. That is changing everything. So this seeps downhill. Whatever the banks do up here, retail sees down the hill. I want you to understand something right now. The market's in a holding. What will happen with rates? Do they get raised or cut? That has different ramifications. Right now, it's better to sit and see what's going to happen. Like I said in the last videos, as long as crude oil gets to a certain range, the attacks stop. If gasoline's between $4.20 or that zone, things chill out for a minute. And if things chill out for a minute, the market recalibrates. So playing this, you're playing both ends against the middle. You watch on the low side when metals get to a certain point corresponding to the oil prices and gasoline hitting around $4.20. At around $4.20, it stops for a second. With that being said, ladies and gentlemen, this is not financial advice, just my own opinion. These levels that we're seeing here right now, as far as I'm concerned, are the last accumulation zones. XRP continues to make advancements in roads, and its picture is right then and there. We're not following some mirage in the desert, ladies and gentlemen. We're not. It's right in front of you. It really, really is. You have to have conviction right here. Ladies and gentlemen, if you want to learn how to take advantage of everything I'm talking about, come and join the Crypto Public Desk Monthly and join over 620 active and traded investors who are learning from this. One tip in the pits can pay for your entire year subscription, ladies and gentlemen. Learn to harness the knowledge and the news to take advantage in every financial instrument that people can trade. But right now, there's a conundrum. See, you can fight inflation by letting yields do it or cutting short-term interest rates. It's one or the other, right? You can do that. That's going to affect prices of metal, gold, silver. It's going to affect crypto prices. I believe there's a bottom in place right now. This is just my own opinion. Every retains any capacity. I think there's a bottom in place right now, and I think Bitcoin will move higher. I think things will move higher from here. I just think that's my own convictions. That's what I am doing, not financial advice. If you want to see how we're taking advantage of the Crypto Public Desk Monthly, I love you all, ladies and gentlemen. Don't get caught up like sushi right here. See what's happening. Take a step back. Take a breath. See the trees from the forest from the trees. You have to see what's happening right now and why things are changing. XRP makes inroads every day, ladies and gentlemen. Inroads. If you can focus out the chaos right here and take a deep breath and see where we're going, you'll have that Gucci conviction, that Gucci clarity. I love you all, ladies and gentlemen. I'm see you on the front lines. None of this is financial advice, just my own opinion and retains any capacity. This video is for educational and entertainment purposes only. Never, ever invest money from watching a YouTube video. Consult your licensed financial advisor. Never, ever, ever invest a single dollar from watching a YouTube video. Don't do that. But you know what? Right now, what a time to be alive. See, as we're following the patterns right here that I say in this part of the video, and if you're here, subscribe to the channel. If you're still here, join the Patreon as well. We're in carnivorous mode because we've got the patterns dialed in. Once the patterns dialed in, and if you're here watching day in, day out, you understand what we're watching and why. Once you see these things, as financial mercenaries, we press, and we go forward. We fight the battle every day. We win daily financial combat every day. Our bank accounts grow. Our trading accounts grow. Our benefactors grow. Our reputation grows. Because in this game, it's not about tweets, not about followers, not about clicks. It's about winning for yourself, for your family, that Gucci conviction, that Gucci clarity. And when we know what's happening and why, we don't get caught up like sushi. Our Gucci conviction grows. We understand what's coming and why. Pigs get slaughtered, hogs get fatter. I love you all, ladies and gentlemen. I'll see you on the front line. Don't FOMO. Don't lose your faith. Don't lose your convictions right here. Don't. I'll see you in the front lines.